Swing trading is a trading style built around patience and market structure. Yet many traders misunderstand what it really involves. Decisions are not rushed and do not depend on constant screen time. Instead of reacting to every small move, the trader focuses on identifying clear price movements that develop with time. The emphasis shifts away from speed and toward planning, context, and consistency. In swing trading, the goal is not to exploit intraday volatility. The focus is on capturing price movements that unfold over several days or even weeks. Trades are allowed to breathe, often remaining open overnight and across multiple sessions. This approach aligns the trader with broader market direction rather than short-term noise within a single trading day. Because positions are held for longer periods, preparation becomes deeper and more deliberate. Entries, risk levels, and targets are based on higher time frame structure, not short-term reactions. Once a trade is placed, the challenge is not execution speed, but emotional stability. The trader must allow price to fluctuate without interfering, trusting the plan instead of reacting to every pullback. Welcome back to the ComLucro channel. This video is part of our Types of Trading course, a structured series where we break down each trading style step by step, always grounded in real market behavior. In this chapter, we focus on swing trading as a professional approach to the markets. We will explain how swing trading works, which timeframes are used, how trades are managed over multiple days, and which trader profiles tend to perform best with this style. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. So, what swing trading really is? Swing trading is a trading style focused on capturing market moves that develop over several days rather than within a single session. The objective is not to react to short-term fluctuations, but to position trades around clear market structure and directional movement. In this approach, trades are opened and managed over days, and sometimes weeks, with positions often held overnight. Because targets are larger than in day trading, consistency comes from aligning with higher time frame direction, managing risk correctly, and repeating the same process across multiple setups, not from frequent decision-making. Swing trading depends strongly on structure and context. Entries, stop losses, and targets are planned in advance using higher time frames, but trade management still plays an important role as price unfolds. Decisions are made calmly and deliberately, allowing the trader to stay objective instead of reacting to short-term volatility. For this reason, swing trading is not about constant monitoring or frequent adjustments. It is about committing to a clear plan and allowing trades the time they need to develop. When structure is ignored, swing trading quickly turns into emotional holding or poor risk control. Swing trading is not passive investing, but a structured process of managing risk and opportunity across multiple market sessions. Now that we understand what swing trading really is, the next step is to look at how it appears on the chart. Swing trading is defined by higher time frames and broader price structure, not by short-term speed. Traders typically focus on the 1-hour, 4-hour, and daily charts, which allow them to identify meaningful market swings and key structural levels with clarity. Trades in swing trading are usually held for several days and sometimes longer, depending on how the market develops. The exact holding time is less important than staying aligned with the original plan, managing risk correctly, and allowing price enough space to move. This balance between patience and discipline defines the swing trading experience and separates structured traders from emotional ones. So, how many trades does swing trading usually involve? And how is the trading process structured? Swing trading is not about constant market exposure or frequent decision-making. Most swing traders take only a small number of trades per week, focusing on clear setups that align with higher time frame structure and direction. Quality matters far more than quantity in this approach. Structure is still essential in swing trading, but it is defined differently. Traders establish clear rules for entries, risk, and trade management across multiple days, including how to handle overnight exposure. Without these rules, patience turns into uncertainty, and trades become emotionally driven holds rather than planned positions. Swing trading works best when decisions are made in advance and execution remains disciplined throughout the life of the trade. So, what are the main advantages and disadvantages of swing trading? One of the biggest advantages of swing trading is perspective. Trades are not influenced by intraday noise, and there is enough time to analyze higher time frame structure, plan entries carefully, and manage positions without constant pressure. This approach allows traders to step back and focus on meaningful price movement. Swing trading also offers the potential to capture larger moves. Because trades develop over several days, targets are wider and fewer decisions are required during the life of the trade. This creates a more stable execution process for traders who prefer planning over rapid reactions. However, swing trading requires emotional tolerance. Trades are held overnight, which exposes positions to gaps, news events, and extended drawdowns. Traders must be comfortable seeing unrealized profit and loss fluctuate without interfering with the plan. Transaction costs are generally lower due to fewer trades, but risk still exists if position sizing and stop placement are poorly managed. Swing trading is mentally demanding in a different way. It rewards patience, discipline, and trust in structure, but punishes fear, overmanagement, and the inability to stay committed once a trade is active. So, what kind of trader is suited for swing trading? Swing trading tends to fit traders who prefer thoughtful decision-making over fast execution. There is time to analyze the market, plan trades in advance, and let positions develop without constant intervention. Confidence in the strategy and trust in the process are essential once a trade is active. This trading style requires emotional stability over longer periods. Wins and losses unfold slowly, and positions may experience pullbacks or temporary drawdowns before reaching their targets. A swing trader must stay calm and objective, allowing price to move without reacting to every fluctuation. Swing traders also need discipline and consistency. While screen time is reduced compared to day trading, the challenge shifts to avoiding unnecessary adjustments or exiting trades too early. The ability to follow the plan and resist the urge to interfere is a key skill. At the same time, swing trading demands comfort with uncertainty and with holding positions overnight. Not every trade will work, and losses must be accepted according to predefined risk rules. For traders who value patience, structure, and long-term thinking, swing trading can feel natural. For others, the slower pace and delayed feedback may feel uncomfortable. Understanding your psychological fit is essential before committing to this style. So, what are the most common mistakes beginners make when swing trading? One of the biggest mistakes is entering trades without a clear higher time frame plan. Because swing trades last longer, entries, stop losses, and targets must be defined with precision. Without this structure, traders react emotionally to price movement and lose consistency. Another frequent mistake is managing trades too actively. After a small pullback or short-term adverse move, some traders interfere with the position, exit too early, or adjust stops without justification. This usually comes from impatience and a lack of trust in the original analysis. Many beginners also underestimate the psychological demands of holding trades overnight. Price can fluctuate significantly between sessions, and reacting emotionally to unrealized profit or loss often leads to poor decisions. Without clear rules for trade management, patience turns into anxiety and discipline breaks down. Confusing swing trading with long-term investing is another common issue. Some traders hold losing positions beyond their planned risk, hoping the market will eventually reverse. In addition, ignoring position sizing and exposure can quietly damage performance over time. Even with fewer trades, poor risk control can turn a solid swing trading approach into a losing one. To wrap up, swing trading is a trading style centered on patience, structure, and disciplined execution over multiple market sessions. It is not about reacting to short-term movement, but about positioning around clear market structure with defined risk. Swing trading rewards planning, emotional stability, and consistency, and quickly exposes impatience, overmanagement, and lack of respect for the trading plan. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure. so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.